Have you ever wondered why some people seem to have a knack for multiplying their money in the stock market? What if I told you that the average annual return on major stock indices over the last decade hovered around 9.2%? That's right. While traditional savings accounts offer minimal interest, the stock market presents a golden opportunity for those who know how to navigate it. Today, we're going to uncover some insider tips that could potentially set you on the path to financial freedom. Whether you're a college student, a working professional, or even nearing retirement, it's never too late to start investing. Let's dive into the strategies that can help you grow your wealth through stocks. Stick around because this is going to be a game changer. Ready to turn those financial dreams into reality? Let's get started. When I first dipped my toes into the world of stock investing, I'll admit, it was overwhelming. My first investment was modest, just a few shares of a company I believed in. Despite the rocky start and the initial losses that made me question my decision, I persisted, eager to understand the complexities of the stock market. And let me tell you, that decision to stick with it has paid off tremendously. Why is this important, you might ask? Well, understanding the stock market isn't just about making money. It's about making smart choices with your hard-earned cash. It's about not just saving for the future, but growing that nest egg. Whether you're planning for retirement, saving for your kids' education, or just looking to increase your financial security, getting to grips with the stock market is crucial. Today, I'm here to guide you through this journey, sharing the very strategies that helped me grow my investments from humble beginnings to substantial holdings. Are you ready to see how you can do the same? Let's break down the essentials of stock investing, step by step. From research to risk management, I'll show you how each piece fits into the puzzle of successful investing. Start with research. The first and perhaps the most critical step in your journey to becoming a savvy investor is thorough research. Understanding the market and its dynamics is crucial. You need to become familiar with how economic indicators, world events, and company news can affect stock prices. For instance, let's consider a real-world example. Take Apple Inc., a giant in the tech industry. Before investing in Apple, a smart investor would look at a variety of factors. These include the company's quarterly earnings reports, any new product launches, and overall market conditions. Additionally, looking at how external factors like trade policies or market trends in consumer electronics could impact Apple's business is essential. Back in 2007, Apple launched the first iPhone, revolutionizing the smartphone industry. Investors who had researched Apple's potential to disrupt markets and noted the growing consumer interest in smartphones could have made an informed decision to invest around this time. As a result, they would have seen substantial returns as Apple's stock price soared following the iPhone's success and subsequent product innovations. This example underscores the importance of not just knowing a company's current standing, but understanding its potential for growth and innovation. Your research should provide a comprehensive picture of where a company stands and where it might be headed in light of broader market trends. Diversify your portfolio. Once you've mastered the art of research, the next step is to diversify your investment portfolio. Diversification is a key strategy for managing risk and increasing the potential for returns. It involves spreading your investments across various sectors and asset types to reduce the impact of any single investment's poor performance. Let's look at a practical example. Imagine you invested all your money in the technology sector. While tech stocks have high growth potential, they're also highly volatile. If the tech sector suddenly dips due to regulatory changes or economic downturns, your entire portfolio would suffer. Now, consider the benefits of diversification. Say, instead of investing solely in technology, you spread your investments across tech, healthcare, consumer goods, and energy. This way, if the tech sector takes a hit, your investments in healthcare or consumer goods might still perform well, balancing out your losses. Take the case of the 2008 financial crisis. Investors who had diversified portfolios, including stocks, bonds, and different sectors, experienced less volatility and recovered their losses much faster than those heavily invested in financial stocks alone. Diversifying doesn't mean you won't experience losses, but it helps in reducing the risk and smoothing out the volatility in your investment returns. It's about not putting all your eggs in one basket and staying prepared for various market conditions. Long-term planning. Investing isn't just about making quick gains, it's about creating lasting wealth. This brings us to our third key strategy: long-term planning. Long-term investing means looking beyond the day-to-day fluctuations of the stock market and focusing on future potential. Consider the example of Warren Buffett, one of the most successful investors in the world. Buffett's strategy focuses on buying quality stocks at reasonable prices and holding on to them for a long time. He's not concerned with short-term market swings. Instead, he looks at a company's long-term potential. Let's look at a specific case. Berkshire Hathaway, Buffett's company, bought shares of CocaCola back in 1988. Despite various market downturns, including the dot-com bubble and the 2008 financial crisis, Buffett held on to these shares, benefiting from steady dividend growth and substantial price appreciation over decades. This example illustrates the power of long-term investing. By committing to Coca-Cola, a company with a strong brand and consistent performance, Buffett not only preserved but greatly increased his investment over time. It's a classic example of how patience pays off. Embrace a long-term perspective in your investing strategy. Look for companies with solid fundamentals, a clear competitive advantage, and a proven track record of growth. Remember, the goal is to build wealth steadily and avoid the pitfalls of reactive, short-term trading. Understand and manage risk. As we delve deeper into the world of stock investing, understanding and managing risk becomes paramount. Every investment carries its own set of risks, but with the right strategies, you can mitigate these and protect your portfolio. Risk management in investing often involves setting stop-loss orders, diversifying investments, and regularly reviewing your portfolio to adjust as needed. Let's explore a practical example of how effective risk management can support investment success. Consider the case of Netflix. In early 2011, Netflix decided to split its DVD rental and streaming services, causing a huge customer backlash and a significant drop in stock price. Investors who had stop-loss orders in place could have minimized their losses by automatically selling their shares during the initial drop. However, for those who managed their risk by holding diversified portfolios and maintaining a long-term perspective, staying invested in Netflix proved beneficial as the company eventually recovered and grew to dominate the streaming industry. This example shows that while it's important to manage immediate risks, understanding the broader context of your investments is also crucial. Effective risk management isn't just about preventing losses, it's about knowing when to hold on through volatility, with a clear understanding of a company's long-term potential. To manage risk effectively, always stay informed about your investments and the factors affecting them. Use tools like stop-loss orders wisely, and ensure your investment decisions are aligned with your financial goals and risk tolerance. Stay informed and keep learning. The final piece of the puzzle in your journey to becoming a successful stock investor is staying informed and continually learning. The stock market is dynamic, constantly influenced by global events, economic changes, and technological advancements. Keeping up with these changes is crucial to making informed investment decisions. Regularly updating your knowledge can make a significant difference in your investment strategy. For instance, let's take the example of Tesla. Investors who closely followed industry trends and Tesla's developments in electric vehicles and renewable energy were well positioned to understand the company's potential before it became apparent to the broader market. Tesla's stock experienced substantial growth as the company launched innovative products like the Model S and expanded into new markets. By staying informed about Tesla's progress and the evolving landscape of the automotive industry, informed investors could capitalize on this growth early on. This example illustrates the importance of being proactive about learning and staying updated on financial news and company developments. It's not enough to set up a portfolio and forget about it. Successful investing requires active engagement and ongoing education. Utilize resources like financial news websites, subscribe to investment newsletters, and participate in financial seminars and webinars. The more you learn, the better equipped you'll be to make smart investment decisions and adapt to the ever-changing market conditions. As we wrap up today's journey through the essentials of stock investing, let's quickly recap the key points we've covered. We started with the importance of thorough research, illustrated by the strategic moves of investors in Apple. Then, we moved on to diversification, where we saw how spreading investments across various sectors can safeguard your portfolio during downturns, much like those who weathered the 2008 financial crisis more smoothly. Next, we emphasized the value of long-term planning, inspired by Warren Buffett's enduring success with Coca-Cola. We also discussed understanding and managing risk, taking a lesson from Netflix's tumultuous but ultimately triumphant path. Finally, we talked about the critical role of staying informed and continually learning, as demonstrated by early investors in Tesla, who recognized its potential long before the mainstream market. Each of these strategies is a crucial component in the toolkit of successful investors. They are not just tactics but principles that guide wise investment decisions. Remember, the goal is not just to invest but to invest wisely and grow your wealth sustainably. Now, I encourage you to take these insights and apply them to your own investing journey. Start small if you must, but start informed. Keep learning, stay engaged, and gradually build your portfolio with confidence. The path to financial freedom isn't overnight, but with persistence and dedication, it is achievable. If you found today's insights helpful, don't forget to subscribe for more financial tips and strategies. And now, I'd love to hear from you. What's your next step in your investment journey? Share your thoughts and questions in the comments below.